Hi there, and welcome to our discussion on Chapter 2. The name of Chapter 2 is Analyzing and Recording Transactions. And just to reinforce, in Chapter 1, we were analyzing the transactions. We were looking at sole proprietorships that are in the service industry and what happened when an owner put some money to start his or her business. What happened when they sold their services, either for cash or on account? What happened when they purchased some supplies or paid for rent, either for cash or on account? What happened when they drew money out of their business? So we looked at all that under the umbrella of the accounting equation, if you remember. And let's just see if we can all say that together. Assets equal liabilities plus equity. And then see if you can, in your mind, kind of remember what those four components of equity were, right? And then whether each of them make equity go up or down. So let's sort of say that together. So owner's capital makes equity go up. Owner's draw makes equity go down. Revenue makes equity go up. And expenses make equity go down. And revenues minus expenses equal, fill in the blank, net income or loss. And our three financial statements that we're going to be preparing, there's one more, the statement of cash flows, but we don't focus on that in this class. And let's just say the financial statements and in what order we have to do them. So first, we have to do the income statement or P&L, revenue minus expense. And we need that number because we take net income or expense into the next financial statement, which is statement of owner's equity. And we have to complete that to get the final balance in the capital account that takes us all the way down to the last financial statement called balance sheet. Assets equals liabilities plus equity. And our ending capital is the equity balance. And that is also the accounting equation. So what we're going to be doing today is moving on from that discussion to a more thorough discussion of how do we actually use our accounting system to not only analyze, but to record the transactions. So as you well know, all of the transactions that go on in a business are the starting point for our financial statements. So step number one is to actually analyze source documents coming into a business. So just see for a moment if you can think of some source documents, like what sorts of things might a business owner be receiving either in snail mail or digitally that he or she needs to take care of. He or she needs to analyze and record. And an example of some of those things might be like an employee's time card or an invoice from a creditor or a supplier. It might be invoices that I send out to my customers because they owe me money. It might be a lease that I just signed. It might be a notes payable that I just signed. So there's this whole slew of source documents. We have to find some method of taking them from the analysis stage, which we did in Chapter 1, and moving on to Chapter 2, we have to find a way to record them. Okay, so what we do to record these events is we record them in something called a general journal. And that's where we're going to start learning about debits and credits. Then we take all the information in the journal and we put that on to our, put that into our general ledger. And then we use our ledger to run a trial balance to make sure everything, all my debits still equal all my credits. And then I can do those financial statements we just talked about. So we just talked about this. Here are some different examples of the source documents that I'm going to use to analyze to do my general journal. So the basis of all this is we are going to be using something called accounts. And there's a separate account for each type of asset, liability, or equity. So for example, I have an account called cash. I have an account called accounts receivable. I have an account called supplies. I have an account called accounts payable. Remember, anything with the word payable is a liability because I owe it, right? I have an account called notes payable. And over in the equity section, I have an account called Lisa Swallow Capital. I have an account called Lisa Swallow Withdrawals. I have an account called Consulting Revenue. I have an account called Payroll Expense. So every single one of those items are a separate account. And when you put all of those together, that is your general ledger. Okay, so remember, I'm analyzing, then I'm journalizing in the general journal, then I'm posting to the general ledger, and the general ledger is a compilation of all the accounts. And there's nothing really new here because we've looked at all this in chapter 1, right? Here's all my assets. And there might be some things in there that you're not familiar with yet, like inventory. Inventory is for a company that sells things, right? Products rather than services. So, you know, Walgreens has an inventory account, whereas my tax consulting business doesn't have any inventory because I sell a service. Prepaid accounts you haven't probably heard of yet. Whenever you see the word prepaid, that means it's an asset. And that's when you pay for something ahead of time, like say you pay for 6 months of rent. So if I write my landlord a check for 12 grand for 6 months of rent, I now have an asset because I have a right to occupy that space for 6 months. And I think you know that anytime you see the word receivable, that means somebody has to pay you. So that's an asset. Here's my liabilities. We recognize the word payable. Whenever you see the word accrued, that means you owe somebody something. And also when you see the word unearned, that's a liability. And what an unearned revenue is if one of your clients gives you money for something you haven't earned yet. And if you remember back to the principles from GAAP, from generally accepted accounting principles, you don't in GAAP-based accounting or accrual-based accounting, you don't record revenues until you earn them. So if I'm up at Snowball and they pay me, I collect money for season tickets in say like September, I'm not going to open my mountain until the 1st of December. All that money, say I got $200,000 for season tickets, that's called unearned revenue. And that is a liability because I owe all those season ticket holders a season. I have to open my mountain and provide them access to ski. So until I do that, all that money that's sitting there in my bank account is unearned revenue, and that's a liability. And of course, here's our 4 types of equity accounts. And this is just another way of looking at all the different assets, the different types of liability. And let me just say, you absolutely need to learn these, and the different types of equity. And again, you've got the 2 things that increase equity and the 2 things that decrease equity. And this basically just goes over that again. Okay, so again, general ledger. A general ledger is all of the accounts and their ending balances. And in most of these examples, we're going to be closing our books every month. Some companies only close their books like once a quarter or once a year, but in these examples, we're going to be closing once a month. The chart of accounts, this is yet another new term, just lists all of your accounts and gives them a number. So all of the assets are going to be first, all of the liabilities next, the capital and the withdrawal account next, then revenues, and then expenses. And there's nothing magic about adding accounts. So if I am like saying doing the bookkeeping for whatever this company is, it looks like they do some consulting and some rentals. If I'm keeping the books for them and all of a sudden I write a check to somebody for property taxes, and I go over here and I'm like, oh, there's no property tax expense account. You just make one. There's nothing magic about it. You just make one. You give it a number that these actually should be alphabetized. I don't know why salaries comes first, but I would, put it somewhere in here between insurance and rent expense and say, property tax expense account number 639. So in software, you can just add those very easily. The next thing we need to look at is what debits and credits are. So the first thing that I want you to do is take everything out of your head that you've ever thought about debits and credits before. So for example, it doesn't have anything to do with debits and credits like in a banking account, in your bank statement. This is debits and credits was invented literally in like the 1300s as a way for Italian merchants to track all of their produce that was being distributed around the world and the revenue that they were owed and the expenses they incurred. So this is like an 800-year-old system. It pertains only to accounting, and it's called double entry. And what this says is that each account, right, all those things we just looked at, from cash to accounts payable to consulting revenue to rent expense, every single account looks like this. Has a left side and a right side. You got to put the name of the account in there so you know what you're talking about. So for example, cash. And the left side of the account is always a debit and the right side is always a credit. And this is just a tool we use. This picture right here is just a tool we use called a T account. And you have one for each ledger account. So every single asset you have, every single liability you have, owner's capital, owner's withdrawal, every revenue, every expense, they all have T accounts, which is really just a ledger account, but a little bit easier to use. It's a tool, okay? What's the piece of this that you have to learn is that each account is always a debit on the left, always a credit on the right, but each type of account has a different normal balance. There's only two choices. There can be a debit type account or a credit type account. Okay, so you literally just need to learn this. Assets by nature are debit type accounts. To increase a debit type account, you debit it. In other words, make an entry on the left-hand side. To decrease an asset account, you credit it. Make an entry on the right-hand side of the account. Okay, so assets equals liabilities. Liabilities are credit type accounts. So it's opposite with them. If you want to increase a liability account, in other words, if you owe more money to somebody or you have more unearned revenue because you owe them some services, you're going to credit it. If you want to decrease your liability, right? So you owe somebody money and then you start to pay down that amount, then you owe them less. You're going to decrease your liability. You're going to debit it. And with equity are also credit type accounts. So to make equity go up, and remember revenues and capital make it go up, they have credit type balances. If you want to make equity go down, you have to debit it. So expenses and drawing are debit type accounts. And this expanded accounting equation slide basically takes everything I just showed you and blows it up a little bit more. Assets are debit type accounts. Liabilities are credit type accounts. Capital's a credit type account. Withdrawals are debit type accounts. Revenues are credit type accounts, and expenses are debit type accounts. And this is just like 101. It's like if you were learning how to speak Spanish or Hebrew or Japanese, the first thing you would do is learn the elemental alphabet, right? This is the alphabet of accounting. So you really, what I'd like you to do now is take out a piece of paper, and I want you to make this tool for yourself to write it out. So just take out, hopefully you have like a blank piece of paper, like typewriter paper or printer paper. But if you don't, just take out a regular old piece of paper, turn it on its side so it's landscape. And I want you to replicate this. This is your tool. This is your cheat sheet. And I have started it. It's really hard to do on Word, but I have started this for you, I guess for me. And it is on your Moodle shell. I'm going to work on it while you do. So get out your paper. And these are the T accounts that are the cheat sheet that we're going to be using to help us remember what type of balance everything has. Right? So I've started this, you can see it, and I want you to actually draw this out yourself so that that's part of the process, is really starting to understand this. So first draw a T account, right? And every single T account, you have to tell me what it is. So assets, right? So you're going to have a T account for cash, a T account for accounts receivable, a T account for equipment. Anytime it's an asset, it's a debit type account. That's its normal balance. So to make it get higher, you debit it. Okay, and that's why I put the plus sign over here. The left side's always a debit, the right side's always a credit. Okay, equals, and then make another T account. Liabilities. Liabilities are credit type accounts, right? So the plus sign goes over here. In other words, that's the normal balance. So to make a liability go up, you credit it, okay? And so go ahead and finish this for the 4 components of equity. So turn off the tape, and the next one's going to say owner's capital, and then your T account, owner's draw, your T account, revenues, your T account, and expenses, your T account. And please go ahead and finish it and put your pluses and minuses on each of them to indicate what the normal balance is. And then I will meet you back on the video. Okay, so when you're done with the task I just gave you, your handwritten sheet should say, you know, assets, and plus sign and a minus sign, and liabilities, and a plus sign and a minus sign, and capital, plus sign, minus sign, etc. It should look a lot like this, but in that kind of easier format I just gave you on that Word document. Okay. Now, let's go to the next level. So now I've got a T account. I've got my cheat sheet in front of me. So at any point in time when I say to you, hey, how do you make an asset go down? You're going to look at that and say, ooh, it's got a debit type balance. So to make it go up, I debit it. To make it go down, I credit it, right? So now we're going to the next step. Here's my T account. I've written in the name, cash. I know that cash is an asset. So to make it go bigger, I'm going to put my little plus sign here to remind me to make cash get bigger, I debit it, and a minus sign here to make cash go smaller, I credit it. An account balance is the difference between all the increases and decreases in an account. So over the course of this month, I had 3 things that made my cash go up, i.e. debits, right? Remember, debit's the left-hand side, credit's the right. I received an investment by the owner. I earned some consulting services and they paid me cash. And it looks like I had an account receivable from a prior period. And now that client paid me the money. I collected it. So all three of those things increased my cash. Then I go over on the right-hand side of the account, which is credit. And in an asset, credits decrease them. And I'm like, oh my goodness, look at all the things that decreased my cash, right? I bought some supplies, I bought some equipment, I paid my rent, I paid some salaries, I paid an accounts payable off, right? So I had an old liability that I paid down, and then I drew some money out. So if I add up all my debits, they equal 36,100. I add up all my credits, they equal 31,300. The difference between those two numbers is 4,800, and my debits were greater than my credits. So it's an ending debit balance, which should make sense to you because we know that's the normal balance for an asset, right, is debit. So that's my ending balance in cash. A T account, remember, is a tool, and a proper ledger account, it looks a little bit different from a T account. It's a little bit more complicated. So we just use T accounts to post our journal entries to, but a real ledger account, I'll show you what that looks like in a minute. But my ending balance is $4,800. That's what I'm going to take to my trial balance and onto my financial statements. Okay, so here is really where we're moving ahead, is on step 3. And if you don't understand anything I've said to this point, or you're a little unsure about things I've said to this point, I would stop the video and go back and re-listen to it and reread the first part of the chapter before you move on. So chapter 1, we identified transactions and we looked at things, source documents, right? Our bills, our receipts, our purchase orders, our bank statements, our employee time cards, etc. Number 2, I spent all of chapter 1 analyzing the transactions using the accounting equation, right? What went up, what went down, and did we keep it in balance? Now we're going to learn how to record all this in a general journal and post to the ledger. And a ledger is really a series of T accounts. Then we're going to use those amounts to run a trial balance and to do our financial statements. Okay, so you should have your tool right in front of you, right? Your debit balance is normal balance for assets, credit balance, etc. Here is what a journal looks like. There are 5 columns. And I would like for you to make one. I'm going to show you this slide, and then I'm going to ask you to make a journal. 5 columns always. The date, the explanation or description column, the PR, which is posting reference. When we post our journal to our ledger, we have to make an indication that we did that so we don't do it twice. And then debits and credits. The date of the transaction, the title of the account you're debiting and crediting goes in here. And remember, debits always have to equal credits. That's how you keep your accounting equation in balance. So the title of the accounts debited and credited, and then you can just jot down a little explanation under there if you'd like. So in your shell, again, I have loaded a document that says General Journal to Practice On. So this is a Word document, but again, at this point right now, this will help you. I want you to take out a piece of paper and make a general journal. 5 columns we just looked at, right? Date, description, posting reference, debits, and credits. And we are going to turn to your book to exercise 2-15. And we are going to use our tool, right, that we just made, the accounting equation with all the debits and credits and try and figure out if we can journalize on page 71, exercise 2-15, what happened to Valdez services. And I'll just give you the dates. Okay. On January 1st, the company paid $2,000 for payment on a 6-month-old accounts payable for office supplies. So 6 months ago, they had bought some office supplies on account. So we have a liability set up called accounts payable. And today, let's just make up a date, 2/14, they are paying off that accounts payable. Oh my goodness, what do I do? What am I going to debit and what am I going to credit and what are the titles of the accounts? So let's go. You would have in your business a chart of accounts. And it would tell you all of the different names of your asset accounts, names of your liability accounts. And again, these are different every company, right? And all your equity accounts. So let's go back and say, hey, what happened to the accounting equation when Valdez paid $6,000 or $2,000 on an old accounts payable? Well, one thing we know is for sure our cash went down because we wrote a check, right? So our asset of cash went down. Then I go over here and I'm like, well, if I paid off an old debt, my accounts payable went down. So now I've analyzed the accounting equation. My assets went down and my liabilities went down. I now need to go to the tool that we made and say, hey, what actually do I do for debits and credits? Well, if cash goes down, do you debit it or credit it? And you credit it, right? You credit an asset to decrease it. And accounts payable went down. What do? We debit a liability to decrease it. It's like, okay, I can do that. I'm going to debit my accounts payable. Debits always come first. And from now on, we're just going to call that AP. And my liability of accounts payable decreased by $2,000. And then the credits come next, and you always indent them. So my cash went down by $2,000. My AP went down by $2,000. And my debits, still equal my credits. Great. Let's try one. We're going to come back to Valdez, but let's go try one of these on the slides. And you're going to put this on your journal. All right, and here's your journal, date, description, posting reference, debit, and credit. This time, the company receives $30,000 of cash from the owner as an investment. So it's like, okay, well, let's analyze that. Here's my accounting equation. Well, what happened? My cash went up by $30,000. Cash is an asset. How do we make assets go up? We debit them. And my equity of C. Taylor Capital went up. How do we make our capital account get bigger? We credit it. So please enter this transaction in your journal. And let's just say that was on the 1st of February. Remember, debits first. So we got a debit cash. So I look at this, my cash went up, my asset of cash, and my owner's equity through the capital. Remember there's those 4 components of equity: capital, withdrawals, revenues, and expenses. My capital account went up by 30,000 and my debits still equal my credits. Let's try the next one. Now my company pays $2,500 for supplies. Okay, so gosh, what happened to my accounting equation? Well, this one's a little different. My cash went down, right? Because I wrote a check. And my asset of the supplies went up. So I'm really only touching the left-hand side of the accounting equation, right? So go to your journal. How do we make an asset go up? We debit it. How do we make an asset go down? We credit it. So let's go record the fact, and let's just say that was on the 3rd of February, that I spent cash to purchase supplies. And remember, you turn the video off whenever you need to listen to something again, to reinforce something, to, because I want you to be manually making these journal entries in the journal you made. I want you to be practicing writing this. Okay. Let's try another one. In this case, my company paid $26,000 for equipment. Paid $26,000 for equipment. So I want you to think about what kind of account is equipment, what kind of account is cash, how do you make equipment go up, how do you make cash go down, turn off the video, and record this in your journal for me, please. And we'll meet back up here. Say it happened on the 5th of February. Is that the right amount? 26,000. Okay, so my asset of equipment went up. My asset of cash went down. I'm looking at my tool that tells me how do you make an asset go up, how do you make an asset go down, and I record it appropriately. Okay, we're not posting yet, so you don't know what's going on over here. All right, now I go and I buy some supplies on credit. I don't write a check. I tell them, hey, I'll pay you later. Now, what happens? I buy, let's say on the 8th of February, $7,100 of supplies, but I don't write a check for it. I say I'm going to pay you later. What's that called again? I think it's called accounts payable. Are you making your liabilities go up or down? So think about that. I'm bringing some supplies in my company, but I'm telling them I'll pay them later. Look at your cheat sheet. What do I debit? What do I credit? Turn off the video and make the journal entry. So when you turn your video back on, you would have debited assets. Supplies is an asset account. How do you make it go up? You debit it. Then my liability of accounts payable went up because I owe more money. How do you make liabilities go up? You credit them. And after each journal entry, I make sure my debits all still equal my credits. And they do. Now I provide some consulting services and my client pays me cash. Okay, this one's kind of new. So by now it's like, okay, I got some cash. That's great. My asset of cash went up. How do I make that increased? I debit cash. But the other side of it is, what is that? And that's a revenue. That's what I am in business to do, is provide consulting. So how do I make a revenue account go up? Go look at your cheat sheet. Revenue is a component of equity. How do you make it go up? You credit it. So let's make our journal entry on our journal. Again, I want you to be physically writing this out. And let's say that happened on the 9th of February. So that's consulting revenue. What happens next? Now I have to pay my rent. And let's pretend that that doesn't say December. Let's pretend that that says February. So I have to pay my February rent. I have to write him a check. So I know that my asset of cash is going to go down. I have to analyze it in the context of the accounting equation. And then also it's like, oh gosh, that's one of those funny 4 components over here in equity. I'm incurring rent expense. So the account of rent expense is going to be impacted. What does rent expense do to equity? It decreases it. So to impact our rent expense account, we have to debit it. And I know that again, because I can look back at my cheat sheet that I made. And I see that expenses have a normal balance of debit. So let's go make our journal entry. Which transaction? Oh, for my rent. I've paid $1,000 for rent. And say I did that also on the 9th. My debit is to my rent expense account, because we just went and looked up that expenses have a debit type balance. It's an equity sub account, so it drops my equity. And I also decreased my asset of cash. How do we decrease an asset? We credit it. All right, let's try a couple more and then we'll go back to Valdez. And then I'm going to give you some little assignments to work on in the book, and you will do those and come back and check in with the lecture that goes over those. So let's go here. Now, I do some more work for my clients. I provide consulting services of $1,600, and I rent out some of my spare space for $300. Okay, so that's great. So what do I debit? And it's all being billed. They're not paying me any cash. So this time I really have to think about this. This isn't cash that I'm debiting. It's an accounts receivable. Accounts receivable is an asset account. Anytime you see the word receivable, that means an asset. Somebody owes me money. So my asset of AR has gone up right here. And in my equity, my little sub-account area of revenue, both consulting revenue and rental revenue have gone up. Let's go make our journal entry. So turn it off, make the journal entry. And again, for the first time, I'll write it all out, but from here on in, I'm just going to put AR, accounts receivable. I now have an asset of $1,900. I have to increase my revenue account, and I go and I look at my little cheat sheet, and it says revenues have normal balances that are credit. To make them go up, you credit them. And I also have to increase my rental revenue by $300. And everything's still in balance. Now, I'd like to turn us back to Valdez, practice a couple more out of here, and then I'm going to show you how to post and send you off to do a little bit of homework. Let's go to number 2, or I guess 1B. For Valdez on page 71, and it says the company paid $1,200 cash for the just completed 2-week salary of the receptionist. So I wrote a check to my receptionist for $1,200. How is that impacting the accounting equation? Well, I know that my cash went down, so you got to record that. And I know that my salary expense was impacted. So turn off the video and make the journal entry, please, on the 10th of February. So in that example, my cash went up. I'm sorry, my cash went down, so I have to credit it. My asset went down of cash. And my expense, I go over to equity. And it's like, okay, equity in general has a credit balance, but because expenses make equity go down, expenses have a debit balance. So I make my journal entry. And I go on and I read the next one, 1C. I paid $39,000 for equipment purchased. Make the journal entry. How does it impact your accounting equation? Assets, liabilities, expenses. And we use assets when what it is that we're purchasing is going to benefit us for more than one period. So is equipment an expense, like it's only going to benefit one period, or is equipment something that's going to benefit us for multiple periods? Make that on the 21st of February. Turn off the video, make the journal entry, and we'll meet back up. Equipment is an asset. It's going to benefit me for many periods. How do we make assets go up? We debit them. And I wrote a check. So my asset of cash went down. How do we make assets go down? We credit them. We're going to do one more journal entry, and that is number 1E. The owner of Valdez Services withdrew $4,500 cash from the business for personal use. So for this one, I think we need to go back one more time and relook at our cheat sheet. What of all of these items I know that my asset of cash went down, right? Because he wrote himself a check out of the business. So I've got to credit my cash. Which of these things do we have to use? And this is an example of a withdrawal. And it makes equity go down, so it has a debit balance. So back here, I'm on, copy this over here so you can see what's going on. Let's say that this is on the 25th. He takes out $4,500 for himself. Okay, so that's B Valdez. And the name of the account is withdrawals, or sometimes it's just called drawing, same thing. It has a debit balance, a normal balance of a debit, because it decreases equity. And I know that my asset of cash also went down. So these are examples of journalizing transactions in the general journal. We know the next step is to post them to the ledger. Then we run a trial balance to make sure all my accounts, all my debits equal my credits, which if you did all this correctly, they should. And then I can run my financial statements, my P&L, my statement of owner's equity, and my balance sheet. So you can see on some of these early ones, I'm posting my debit posts up to the left-hand side here, debit of the T account. And remember, all T accounts, the debits are always on the left, the credits are always on the right, and then you have to have the name of the account and the number that's assigned it in the chart of accounts. And then I credit my capital account. Over here, now I'm posting, and you post at the end of the month. My supplies were a debit, so they go over here and debit my T account. My cash was a credit, so I come over here and credit my T account. So you've got a whole piece of paper full of a ton of T accounts. Cash, AR, equipment, supplies, consulting revenue, rent expense, salary expense, drawing, capital. Every single one of those has its own T account, and you post journal entry by journal entry. And as you do that, you indicate in your journal, oh, hey, that went to account 201, and this went to account 101, right? This is your posting reference. And account 101, and I'm just making these up. I don't know if this is actually what's in the chart of accounts, but I would look up the chart of accounts and it would tell me, and remember, all the assets are 100s, all the liabilities are 200s, et cetera, et cetera. So I go post all my debits and credits one by one by one to the ledger. It's very easy to just use a T account, but what a proper ledger account looks like, I've got an example of it on your Moodle account, and this is what it looks like. So, sorry. So they're a little bit more, there's more to them than just a T account, which is why we use a T account. But say here, that first example, let me go back to my journal for cash, was to credit cash for 2,000 and then debit it for 30,000. So on your ledger, I'm not sure what the dates were. You don't really need anything in the explanation column. I'm not sure even why they have it in your book. Posting reference, that's where did it come from? So first, I think I I've got new, oops. See, I put in cash of 30,000. So that ends up with a balance of 30,000. You have to put the name of the account, obviously, because that's right. So that tells you, you know, that cash has a normal balance of debit. So that's what happens out here. And then say the other post was I spent 2,000. So now my balance is, of course, 28,000. So remember, the balance is whatever the normal balance for that type of account is. And you can give yourself a hint by penciling in debit or credit above the word balance. So in here with cash, I would just pencil in debit. Okay. So you have one of these. This is what a proper general ledger account looks like for each account in your general ledger. And again, we just use T accounts because they're so much easier. So what I would like you to do to continue to learn in this chapter is these items right here. Quick study 2-13, which is on page 68. And then exercise 2-3 on page 69. Exercise 2-4 and exercise 2-8. So do those and then come walk through this video with me and correct all these. And we're going to reinforce journalizing. We're going to reinforce posting. And then I'm going to show you how to do financial statements. So that's the next thing that I would like you to do. And I hope that this has been really super helpful for you. And go ahead, do the work. I would do all this before I took the reading quiz or the homework, because this is all supposed to make you savvier to get ready to do that. So thank you very much. I have enjoyed this recording.